Welcome to RBC's Markets in Motion podcast, recorded October 21st, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, solid commentary from the S&P 500 financials that reported last week helped get 3Q reporting season off to a good start, though it was overshadowed by private credit concerns. Second, we reviewed stock market performance in early 2023 around the regional banking crisis as a starting point for thinking about risks to the broader U.S. equity market. Third, other things that jump out include further deterioration in earnings revision trends for the major indices and stalling sentiment. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1 on last week's earnings calls. Solid commentary from the financials was overshadowed by private credit concerns. Based on our transcript reading on the broader macro, the financials that reported generally see a resilient economy and healthy and consistent consumer, while acknowledging macro uncertainty and the unevenness or K-shaped nature of the underlying economy. These companies generally highlighted strong capital markets activity and pipelines, good credit quality, potential tailwinds from lower rates, and improving loan demand and corporate sentiment. One bank stood out for noting greater comfort among their customer base in making longer-term decisions due to increased certainty over tariffs and trade. Another stood out when they described how some of their clients had deferred capital expenditures and had been renting, but that they'd been getting requests for financing to shift from rent to own. Yet another company said clients had continued engaging in CapEx, but that it was heavily in tech, software, transportation, and equipment, while spending on new buildings remained in decline. Meanwhile, the handful of companies that reported from industrials, consumer discretionary, healthcare, and REITs struck a more balanced tone, but were admittedly mixed and came across a notch cooler than the financials as a group. Some companies painted the picture of a sluggish industrial economy with pockets of strength, while others were clearly more constructive. Macro uncertainty emanating from trade and tariffs remained in focus, along with mitigation efforts including supply chain adjustments and surgical pricing. One industrial stood out for their acknowledgement that they had limited visibility on how trade policy would impact 4Q demand, as well as their insight into customer sentiment regarding tariffs. They noted, "It isn't so much what the prices reset to, it's are the prices done resetting, so customers can make decisions about what they want to do because they know the economics of what they want to do." Meanwhile, a REIT observed that customers have definitely become more desensitized to the short-term noise as they look at making long-term decisions. On the consumer, one restaurant highlighted a slowing across the restaurant industry broadly. Outside of financials, we think it's too early to conclude too much about the key themes of 3Q reporting season and look forward to hearing from more companies in other sectors in coming weeks. On the financials, our bank's analysts, while taking the private credit concerns with diligence, have generally liked what they've seen from the results as well. Moving on to takeaway number 2, lessons from early 2023. The financial community is in the midst of a discovery process on the private credit concerns that emerged last week, and for now we will simply have to wait and see how things unfold. There are no perfect historic examples that we, from a U.S. equity strategy perspective, can point to. That being said, we spent some time last week looking at stock market performance around the regional bank crisis of early 2023 as a starting point to think through broader market risks. We have 3 key thoughts. First, the exercise reminded us that the S&P 500 took a hit in early 2023, but not a GFC-sized one, 7.8% in the S&P from the early February high and 4.8% from the early March high. This is a garden variety pullback on our tiers of fear framework. Second, early 2023 was not a good time to get into small caps. The drops in the Russell 2000 were much worse, more than 14% using the Russell 2000's early February peak and nearly 11% using its early March peak. Additionally, it took longer for the Russell to find its footing. While the S&P put in a clear bottom on March 13th, the Russell made an initial one on March 23rd, chopped around, and closed a tiny bit lower on May 4th. Both the S&P 500 and Russell 2000 went on to rebound through early August. The S&P rose 18.7%, while the Russell rose just 16%. Third, the early 2023 playbook in terms of sectors. Tech, staples, and healthcare held up best initially in the S&P 500 as the index fell. In the rebound, communication services, discretionary, and tech outperformed the broader S&P index, not financials, which was middle of the pack. After performing the worst of any small cap sector on the way down, we did see Russell 2000 financials outperform, beating both the Russell and the S&P in the rebound when the early May low is used as the starting point. Overall, this exercise reminded us how a recent shock to banks flowed through to the broader indices. In terms of our equity market views today, we've been on guard for a pullback in the 5 to 10% range in the S&P for other reasons. For now, we primarily see this issue as contributing to elevated investor angst, which could spark profit taking. We also think it will be difficult for leadership to shift from small caps while this issue remains an overhang, given the heavy weightings of financials and banks in the Russell 2000, unless the AI theme also breaks down in a significant way. And we'll wrap up with takeaway number 3. What else we're thinking about? Fading earnings revisions and sentiment. The rate of upward EPS estimate revisions for both the S&P 500 and Russell 2000 continued to deteriorate in our latest update, with this stat slipping to 52.1% for the S&P and 48.4% for the Russell 2000. Deterioration has become even more evident for the top 10 market cap names in the S&P 500, a proxy for the AI megacap growth trade, which have been the workhorses of the U.S. equity market from an earnings perspective. As a reminder, the deterioration in earnings sentiment, which surged from typical non-crisis lows in late April to typical non-crisis recovery peaks in mid-August, has been one thing keeping us on guard for a Tier 1 pullback in U.S. equities this fall, along with stretched valuations, weak seasonals, choppy Bitcoin trends, weaker U.S. equity flows, recent declines in our sentiment indicator, and jittery investors in our meetings that we've worried would be inclined to take profits soon. On sentiment, net bulls retreated in the weekly AAII survey of individual investors last week. The 4-week average came in at 1% on the back of a weekly data point of minus 12.4, the first negative weekly data point in 4 weeks. This sharp move lower came just 1 week after the weekly data point had returned to the summer's high watermark. The shift in individual investor sentiment on this survey now syncs up with the deterioration in tone that we've heard from institutional investors around the globe in recent weeks, as concerns about valuation, AI, CapEx, rate cuts, and private credit have percolated. Importantly, we have seen recent signs of a stall in the recovery and sentiment on other surveys as well, including last week's NFIB survey, in which small business optimism ticked lower and uncertainty rose, as well as the widely followed consumer confidence surveys. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.